Today's topic: avoid these future retirement mistakes as a high income earner now. That's right. You're making the big bucks. You're doing good. You're crushing it. What can you be doing better, though, to be thinking about your future retirement plans? While we are enjoying the accumulation years, there are little things that we can be doing now to preserve an even better future retirement. And that is our goal in today's video. We want to walk through 5 ideas for you to keep in mind, not only for today, but also for tomorrow. And as you know, we don't have the intro video anymore. So I just kindly ask you, if you haven't subscribed, subscribe now. Click on the little bell icon. You'll get a notification every time we release a new video. Share your thoughts, comments, questions, things you'd like to see in the comments below. But without further ado, let's get into it. All right, first up, not saving enough. You got the money coming in, but you're forgetting to stock it away. And this actually seems like something that is missed more and more by high income households, only because you have so many things going on likely to produce this high income, aka busy professionals, probably crazy kids running around, business life, spouse, all the crazy parts that come with it, that you can just put some stuff in autopilot. Is it enough? Only time will tell, right? This is why it helps to work with a good financial planner or to be DIYing this in a very detailed capacity on your own. But saving enough is key. Now, the hard part here is, and I know you always want me to say, well, this is the perfect amount or this is the perfect amount. It's hard to tell because it's really based on a lot of assumptions, but also, what does your future retirement budget look like? That's a very difficult question to answer for anyone, let alone through a YouTube video. I think for most high income professionals, 15 to 20% should be kind of a baseline. Usually for our physicians, I'll lean a little bit more towards 20 because we get a little bit later start. Not for everyone. It also, again, really depends on what the future will look like in terms of your spending needs. My one piece of advice always for high income households now is you do build in a certain lifestyle. Whether you want to admit this or not, you likely are building in a pretty good lifestyle now. And it's very rare for people to retire and want to lower their standard of living, which is why I do think it puts a little extra stress on a higher savings number. Again, I won't be able to give you that exact number today, but that would be one that you want to work on with your financial planner. And again, even there, it's not going to be perfect. There's so many assumptions, but hitting a number, again, maybe it's 15, maybe it's 20. If you're going for earlier financial independence, it might be higher than that. If you have a higher spending goal later on, could be higher than that. If maybe it's going to be a little bit more modest, maybe it could be lower than that. But I think that's a fair number to at least throw out there, but still confirm that, work with a good financial planner and work on that. But not saving enough as a high income earner today could be one of the most costly, if not the most costly retirement mistake that you could face in the future. All right, number 2 on the list, lifestyle creep. High income household with that income, got to start to keep up with the Joneses a little bit. This is what we call lifestyle creep. Our best example is usually with our physicians. They go from residency or fellowship, they're making maybe $60,000, $70,000 per year. Then boom, they hit their attending pay and it multiplies up to $250,000 or $300,000 per year. Just a very large increase in income, maybe even higher than that. And with that, it's not uncommon for that budget to inflate. That lifestyle creep kicks in. And to an extent, that's good, right? It's okay to have some of that. You should have some of that. But also make sure you're hitting your savings goals. And to my last point I made, even in number 1 on not saving enough, right? One of the bigger issues here is when you build in that higher lifestyle today and you grow with it, you're very unlikely to want to depart from that come retirement time. Most people don't work their butts off their entire lives to say, you know what? I want to cut back now in retirement. And sure, your expenses will change and you might not have your mortgage payment anymore, but maybe you added a vacation home or you're taking the grandkids on lots of vacations. The budget does have a very weird way of filling in, even once a big expense falls off. We tell all of our clients in the accumulation years, headed into the retirement years, that same comment. So be very systematized and organized with your budget, not only today, but as your income grows and you grow, keep that budget in check. Not only is it important for today, but it's also very important for the future. Number 3, one of my favorite topics, heck, if not my favorite topic in today's financial planning world, tax planning. Not only today, but also tomorrow. And today, in terms of tax planning, it's in the accumulation years, I kind of always refer to as like the low hanging fruit. Are you maxing out your 403B? Are you maxing out your TSP? Are you maxing out your 401k? Are you taking advantage of the 457B plan? Are you putting money in the HSA? You're cranking away that backdoor Roth IRA? Are you putting money into the brokerage account, the joint account? Are you taking advantage of all those pre-tax deductions? Technically, the backdoor Roth is not a pre-tax deduction, but are you taking advantage of all those pre-tax accounts to really help your tax bill today? Do you understand your taxes? Do you understand the difference between an itemized deduction and a standard deduction? Are you taking advantage of all the things that maybe come with a side gig and some 1099 income? Are you taking advantage of a DAF, a donor advised fund? We could go on for days, but there is tax planning that needs to be done today. Every year, your biggest bill, year in and year out, and even when you retire, is your tax bill. Make sure you give it the respect that it deserves year in and year out. Find a good financial planner, find an even better CPA that they can collaborate together and really help you on this. That's just today. Also in the future, tax planning becomes, heck, I'd argue even more important in decumulation planning. We kind of have this like inside joke in terms of financial planning where the accumulator years are kind of easy in terms of just cranking money away. It's very easy to save money to those buckets. It's not as easy when it comes time to strategize on getting the money out of those accounts, right? So that decumulation planning, which is going to have a huge effect on the tax planning side, right? Because if you're pulling money out of a 401k or an IRA, very taxable. Are we taking advantage of QCDs? What effect are RMDs going to have? Did you run through the most beautiful time in all of tax planning between your retirement years and your RMDs year? Are you taking advantage of those Roth conversions in those years? Very important steps in terms of future retirement planning. And, depends on your net worth. You get into very detailed estate planning. We worry about federal estate taxes. These are all parts that are vital, but they not only apply to today in terms of tax planning, but really almost even more so in retirement planning and that decumulation planning because of one, the numbers are likely much larger. There's also more moving parts. We get into how are we pulling it out of those accounts. So tax planning from the moment you watch this video till the moment you leave this beautiful world, very, very important. You can even argue the moment after you leave this beautiful world if we get into that federal estate tax issues and even state estate tax issues. So tax planning, number 3 thing you need to keep an eye on, not only today, but also tomorrow with that high income and then planning for the future retirement years. All right, number 4 on the list. You probably weren't expecting this one, but saving too much. You're sitting here as a high income earner and you are just cranking away. I said my 15 to 20% earlier, but you're way past that number. Are you saving too much? You're probably thinking, what financial advisor would say that in their right mind? Well, again, one of my jokes with my clients is always, the day I tell you you don't need to save that much anymore should make you feel really good. And while I have yet to have a client call me in retirement and say, Chad, why'd you do this to me? I have so much money. We're traveling. We're enjoying all this. Why would you do this? There is a delicate balance, though. There is that very important aspect of making sure that we're living today while still planning to enjoy tomorrow. And this one is a little bit harder, in my opinion, again, biased opinion as a financial advisor, to probably calculate without a financial advisor because you do want to be looking more towards that longer term. Now, there's good online calculators. Heck, you get the old 12 HPC out and probably run some pretty good numbers on it. But this is where I think having a good professional to walk you through what this could look like. Because the downside to this, what if you're not saving enough? You go back up to number 1. The further you go down that line, it's going to be a lot harder to fix that. So it truly is finding that delicate mix. But there are a lot of times that we have conversations with clients and we'll look at the future numbers and we'll say, is there anything else you want to be doing today? Because we could just keep hoarding money into those taxable brokerage accounts. We can just hoard money in there, assuming we took care of all the tax advantage stuff now. Just keep saving, keep shoveling in there. But is there anything else you could be doing today? The joke that I always like to make, our kids won't always think we're that cool. There's this period of time where they think we're really cool. Then they hit those teenage years where they want nothing to do with us. And then eventually when they realize we pick up the tab on other things and they get a little bit older, we get a little bit older, we're cool again. But there's a period of time where you might not be the coolest. So keep that in mind. Do lots of things today. Do lots of travel. What health is there? We're never promised tomorrow, sadly enough. So number 4 on the list is probably one you did not expect, but are you saving too much today that it could actually adversely affect your future retirement and really more or less by missing out on what you could have done today? But also, if there is too much later on and you didn't need all that, it does add in some layers too in terms of tax planning then, estate planning. Again, good problems to have, or what I like to say, champagne problems. Keep an eye on that. Find that delicate mix. Make sure you're still enjoying today as well while planning for. Last but not least, number 5, decumulation planning. I know I noted this pretty heavily going back into number 3 on the tax planning, but decumulation planning is the process of actually pulling assets out of your investment account. How do you start to utilize those big buckets, those big nest eggs that you built up to now live off of? And this takes a lot of strategic planning. Some of this strategic planning, I know I've said this before, and it's one of my favorite topics out there, Roth conversions will actually even occur almost before decumulation planning. You hit your retirement phase or when income slows down, and before those RMDs, our minimum distributions, fire up, call it early to mid 70s, depends on your birth year. There's a lot of planning that can occur in that period of time to really balance your buckets, also control your tax bill a little bit with those Roth conversions. But decumulation planning is a lot more complicated than the accumulation phase. Accumulation phase, save, hit this bucket, anything left over, go to this bucket. Decumulation planning, you're keeping an eye on tax brackets. You go through all your pre-tax assets first, then your taxable assets, then your Roth. You maybe switch that up based on the current tax code in a given year, maybe throw a curveball and mix those up even more crazy. That is where there is a lot of strategy that comes into financial planning. Now, if you're watching this video, you're likely in those accumulator years. You're in that save. Nothing wrong with that. Keep saving, keep doing your thing, but just be prepared for that decumulation planning. And one of my favorite theories, it's pretty much impossible to do, but one of my favorite theories is if you could retire, you would have 3 buckets, equal parts in them. You'd have a pre-tax bucket. Think of this as your 401k IRA. You'd have an after-tax bucket. So this is your Roth bucket. So think of anything that you built up by just doing backdoor Roth IRAs year after year after year, decade after decade after decade. Also, we'd start to get some Roth conversions going in here. And then your third bucket would be your taxable account, your individual brokerage account or your joint brokerage account. Because if you have all 3 of those, you have the entire tax code at your disposal. No matter what the tax code would do or change, you have some pre-tax assets, you have some after-tax assets, you have some, we'll call them capital gains or those brokerage account assets. So you would have all 3 buckets. Now, again, pretty much impossible to do that, very hard to do that, but it is a cool way to think of it and a neat way to stay tax diversified with those buckets. So number 5 on the list, decumulation planning, starting to give that some thought. You really won't be able to hone in too much on this probably till you are closer to retirement. But in terms of avoiding future retirement stakes, this is why backdoor Roth IRAs, not very attractive in a given year, right? Not a ton of money, but you're building up Roth assets. Pre-tax assets, same idea. Taxable account, same idea. A lot of flexibility in those brokerage accounts. So number 5, decumulation planning. And there you have it. Avoid these 5 future retirement mistakes as a high income earner now. Things for you to keep in mind in these fantastic, fun, awesome accumulator years that you do not want to forget about once you hit those decumulation years in those future retirement years. Again, a little bit more high level in this video, even kept it a little bit shorter. Didn't get anything to too much, but I feel based on some of the questions we've seen, this is just really good food for thought. Something for you to build on, something to think about as you go forward. As always, thank you for hanging out with me for the last 10, 15 minutes or so. If you have not done so, please subscribe to the channel. If you click on the bell icon, you also get a notification every time we release a new video like this one. Also, questions, comments, anything you'd like to see in future videos, drop those down below in the show notes. We'd love to get in on those. As you'll see on past comments, we always are trying to get back to you. We're reading those as well to also create future content. But if you have questions, send them our way. Again, thanks for hanging out with me, and I will catch you on the next video.